Hey, what's up everybody? My name's Lewis. Welcome to the channel. Today is going to be a big day for the markets. As you may or may not know, our Fed Chair Jerome Powell is going to speak at the FOMC today. And what he says or doesn't say is going to have a huge impact on the market. So I want to talk real quickly about what's going to be important, what to focus in on, and how that might impact your investing decisions. So let's get into it. Okay, the first thing that the Fed's going to do is they're either going to take a dovish or a hawkish stance. If you don't know what that means, if they are dovish, that means they are okay with interest running hot and they want to keep interest rates low. With that type of an environment, it's basically accommodative to grow stocks. That's why right now, with very low interest rates and inflation basically allowed to being with inflation allowing to run as hot as it needs to sustain that growth, we're seeing high-flying stocks like Amazon, Facebook, Tesla, Microsoft, all the FANG stocks, Google, running through the roof. And that's because interest rates are low. A 30 times PE ratio might seem high from a historical standpoint, but when you compare it to low interest rates, it's actually a pretty good return. But as those interest rates creep up, then those valuations have to come down. Hawkish is essentially the exact opposite, that they want to control inflation and they are okay to raise rates. If that happens, that's going to have a catastrophic impact on the market. The market will see that as non-accommodative and people will adjust accordingly. And mainly the biggest thing that will probably happen is that those high value stocks, think again, those FANG stocks will have downward pressure on their price as bond yields go up. So hawkish, dovish, what's going to happen? Well, let's first take a look at where the entire market is as it stands today. If you take a look at the major indices, S&P 500, the NASDAQ, and the Dow Jones, they're pretty much at all-time highs. Yes, they might be bouncing off those highs, but they're within 10% of their all-time high. So the market is kind of waiting to see what Jerome Powell says or doesn't say, and then again, adjust accordingly. Now going into the non-equity side, what does gold look like? Well, if you look at gold's chart, it's been under tremendous pressure and it's hovering right around the $1,700 an ounce price range. Gold typically works as an inverse relationship to the bond yield. So with lower bond yields, we typically like to see gold going up in price. But that's not really happening because we've been seeing the bond prices going up, which means that gold is getting pressure to move down. So depending on where those kind of sit, we're going to see whether or not that equilibrium holds true. Now, crypto is another asset that is somewhat tied to the bond rate. As bond prices go up, it should push prices in crypto down and vice versa, very similar to gold. A lot of people are looking at Bitcoin and Ethereum as gold 2.0 or digital gold. So we kind of want to expect that crypto will act a lot like gold, but we're seeing gold price go down while crypto prices go up. And I think Bitcoin is just being Bitcoin. It's completely different, but what it's going to do is right now it's definitely in a bull market where we expect the price to go up to, let's say, $100,000 this cycle. Based on some estimates, maybe it will get there, maybe it won't. But we all know most likely if you take today's price and compare it to what the price will be in, let's say, September, it's most likely going to be higher. What the Fed decides to do really just has an impact on how quickly Bitcoin will get to those price targets. So depending on today, you might see a huge pump in the crypto market. It might stay stagnant or it might drop. I know that's every possible scenario, but I'm not here to predict the future. I'm only here to think about if this happens, then this is what I'm going to do because of it. You have to react to the market and don't get too caught up in predicting it. Every now and then you might get a flag that you might get a huge winner that 10x's because you made the right call. But if you want to be consistent over time, you have to understand what moves the market and how the market moves. All right, so with all that being said, as you can imagine, the market can go either way today. It could go up, it could go down, or it could stay choppy. That's not helpful at all. If you want to sift through the noise and focus on signal, here are some quick facts to help you understand what's going on in the market. Right now, the Federal Reserve is making roughly $120 billion in purchases a year. This is money that is being injected into our economic system. They are buying $80 billion worth of treasuries and $40 billion worth of mortgages. They are doing this to keep our economy afloat and to maintain the growth curve that we're currently on. On top of that, the White House recently approved, or Congress recently approved, a $1.9 trillion stimulus that includes $1,400 direct payments to people like you and me if you make less than $160,000 a year as a family. So that money is going directly into people's pockets, will again make its way back into the economy. We're also anticipating that of the roughly $350 billion that people are getting, maybe 10 or 20% of that is going to end up right back into the stock market with new purchases, especially if you're thinking about those Robinhood investors, or people will be buying cryptocurrency. So think about Bitcoin, Ethereum, or some of the other altcoins. That's another $35 billion boost to these markets just with people's direct payments. So with that, there's just money coming into the system. So given that backdrop, what's happening? Are they going to be dovish? Are they going to be hawkish? They're spending money like crazy. Jerome knows that what he says or doesn't say has a huge impact. So here's my guess. I think they're going to kind of stay the course. Right now he knows that what he says is going to have such an impact to move the market. If he says they're going to try to curb inflation, which means limit growth, and let the bond rates go up, that's going to put downward pressure on the stock market. You'll see all the indices at all-time highs take a turn south. They're just going to go down because now the bond market becomes more attractive because interest rates are higher. So I don't think he's going to do that. On top of it, as I mentioned, they're already spending roughly $120 billion a month. Every single month, $120 billion is entering the market. It's just like if you were getting $10,000 a month and somebody just stopped giving you that money, how would that impact your lifestyle? Well, that's exactly how our economy works. They can't pull the plug on that just yet, though things are trending in a better direction, which I know he will touch on that most indicators are getting a lot more favorable versus this time last year. It's still not favorable enough to make any drastic changes to the current policy. And lastly, it's not just about what decisions they're going to make. What can they do? Think about it this way. With the $1.9 trillion being pumped into the economy, that money was essentially created, printed out of thin air. Well, when we create money, we're creating a debt obligation in the form of a US Treasury. Well, in order for the government to pay that back, they work just like when you take out a mortgage. You buy a house for $300,000, you're gonna have to pay that money back. Well, if you allow interest rates to go higher, that debt becomes a lot more expensive to service. It works the same way for the US government. This $1.9 trillion is a massive loan that is put on to the American people. And if rates are allowed to go too high, that debt becomes more and more expensive to service. So the Fed, under no circumstance, can allow the interest rate to get too high to a point where we become insolvent as a nation. Big scary word, I don't think we're there, but if interest rates go too high, we are going down that path of insolvency. So I don't think there's any way that the government can let the interest rates go too high. Yes, they might uptick a little bit more, but still they are at historic lows, even where they sit today, under 2%, bouncing between 1 or 2%. So I think today, Jerome's not going to say too much, going to kind of lean into the fact that the economy is getting better, but not make any drastic changes. Now, when it comes to interest rate control, I do think they will try to hint a little bit to say, you know what, we're going to control these interest rates. They will not get out of hand, because if the debt becomes too much to service, they have to print more money. If you print more money, you create more debt, which makes your debt obligation bigger, and it becomes a vicious cycle. And given today's environment, we're thinking we could print our way out of this huge disaster that's going on right now. So what do I think? I think not too much is going to happen. I think the market's going to be a little choppy, continue its march upward, and until the next event, there's not much to take a look at. So what would I advise people to do? Hang tight. It's going to take about a day or two before the market really reacts to what Jerome says. We might get some big pumps and dumps depending on what the market perceives his position to be, dovish or hawkish. But after that settles, we will get clearer direction on where the market goes. So pay attention. Hopefully that helps. If you stuck around this long, please like, comment, and subscribe. It's helping out my channel. 3 videos. I guess we're going to keep working on that stuff. I don't know how to end these things. I'm sure they'll get better over time. But thanks so much for watching, and I will see you in the next video. Take care.